Hello, I'm David Cassidy with the weekly market update for the week ending Friday, the 24th of April. Global equity markets this week bounced between gains and losses before finishing the week slightly lower, as volatility and uncertainty was again the key theme given the mixed coronavirus headlines, the oil price, economic data and US Q1 company earnings. While the economic data was horrendously bad, it didn't tell us anything we didn't already know. In other words, the global economy has hit a brick wall. Additionally, once the data goes beyond a certain point, it almost fails to matter, let alone shock. For example, last Monday, the 20th of April, when the price of a barrel of West Texas Intermediate, WTI, oil fell below $0 for the first time in its history, it didn't make a substantial difference when it went on to touch minus $40, as we all knew that the world was running out of storage space given the glut of oil due to the fall in demand caused by the coronavirus lockdowns. Similarly was the UK Purchasing Managers Index, PMI, reading of 12.9, actually any worse than the US reading of 27.4, when any reading below 50 signifies economic contraction. Likewise, news that the US lost another 4.3 million jobs last week, taking the total number of US jobs lost in the past 5 weeks to over 26 million, had no negative impact on equity markets, as again, we all know that it is due to the coronavirus lockdowns which has hit those jobs with a high risk of layoff particularly hard, such as those in restaurants and in retail. Given the negative data, it's not unreasonable to ask why we are so sure that we will see a V-shaped economic recovery given this negative news flow. We fully understand that this may appear bemusing, as the global economic damage from the coronavirus outbreak is massive. However, our belief is based on the fact that while some consumer purchases and business investments will be lost forever, many will simply be delayed. For example, we won't all get our hair cut twice next month simply because we couldn't get it cut this month. Likewise, given all the sporting fixtures such as Wimbledon and concerts that have been cancelled, means that wages won't be earned, flights and hotels won't be booked, souvenirs won't be collected and less alcohol will be consumed. This is all income and expenditure that is permanently lost and therefore a permanent loss to the global economy. However, some events such as the 2020 Summer Olympics or the UEFA Euro 2020 competition have simply been postponed to 2021, so that delayed expenditure will help the economic rebound. Likewise, as we saw in South Korea last weekend, once the lockdown restrictions were lifted, long queues formed outside shops such as Apple. So clearly, purchases of iPhones, iPads and AirPods have simply been delayed, which means it is only a temporary loss to the global economy, not a permanent loss, and shows that once lockdowns are lifted, people are happy to quickly get back to business as usual and start consuming. As a result, while we have no doubt that it will be a sharp and painful downturn, in fact, we wouldn't be surprised if UK Q2 GDP shows a decline of over 30% compared to the same quarter last year. As much of our expenditure will only be delayed, the downturn should be relatively short, with a sharp acceleration on the other side of this horrible coronavirus outbreak. Hence our view that we will start to see an economic recovery towards the end of the year. As a result, while UK GDP will be negative for 2020, it may only be in the single digits, while 2021 could be one of the strongest years since the global financial crisis in 2008-2009. Hence, our V-shaped economic recovery view, and why we believe it is best to focus on the likely duration of the economic decline rather than the depth. Nevertheless, that doesn't mean the path for financial markets will be smooth, as we fully expect market volatility will remain elevated in the short term. However, because we believe that we will see a V-shaped recovery, it is imperative to maintain a long-term perspective by looking past all these short-term negative news headlines, as we are currently seeing, and resist the urge to sell your investments. As Charles Mackesy put it in his book, The Boy, the Mole, the Fox and the Horse, "What's the best thing you've learned about storms?" "That they end," said the horse. Looking ahead to this coming week, we have Q1 GDP data from both the US and Eurozone, and both could easily contract by a couple of percentage points or so, thanks to the coronavirus lockdowns, which kicked in during March. The Fed's preferred inflation measure, the PCE, Eurozone CPI inflation, which is likely to continue decelerating due to lower oil prices, weekly US jobless claims on Thursday, the 30th of April, and Chinese PMI. Additionally, both the Fed and the ECB have monetary policy meetings this week, while in the UK we have over 20 FTSE 100 companies reporting results, of which around 10 are held in client portfolios, including BP, Royal Dutch Shell, HSBC, Lloyds, Barclays, GlaxoSmithKline, AstraZeneca, Glencore, Reckitt Benckiser and Next.